Some of the biggest names on Wall Street are gathering at Bank of America's Global Research Financial Services Conference in Miami, including executives of recently battered private credit companies. Leslie Picker joins us with some of the highlights. Leslie.
Hey, Mike. Yeah, it's been a busy few weeks for alternative asset managers, many of which got caught up in the software sell-off due to concerns about exposure among both private equity and private credit. And then over the last few days, of course, the publicly traded ones reported earnings where they disclosed somewhat minimal exposure to the software space, but most are still trading lower by double digits just over the last month. So today, as you mentioned, executives at the financial services conferences in Miami continue to try and explain their story. Overall, they made the case that their exposure to software is small, that they've been super selective in the space, and they're surprised by the market reaction and their role in that reaction. Here's Ares CEO Michael Arrighetti.
It is quite odd to us that the public markets have woken up to AI disruption as a theme. If you've been investing over the last 5+ years and you haven't been thinking about opportunities and risks created from technology and AI implementation, you've probably been asleep at the switch.
Blackstone CFO Michael Chase said, whenever you see such, quote, indiscriminate and very technical trading against a whole sector, as you have seen with software stocks, that almost definitely means it's being overdone. KKR CFO Rob Lewin said they have not gone and re-underwritten their software exposure and its impact on the portfolio because they've been, quote, doing that consistently for a long period of time. He said the big and unknown variable of AI could be negative for some software names in the portfolio, but it could also get the benefit of AI as well. It's just too quick to kind of make those underwriting decisions, I guess, over the course of a week, Mike.
For sure. I do wonder, I mean, you can't tell in the moment exactly what investors collectively are worried about here. Clearly, exposure to potentially weakening software credits is one thing, but there's also, in everybody's mind, the fact that these players are having a large role in the financing of the data center build out, and they've really kind of ridden this kind of asset raising boom in private credit. And I just wonder if people are feeling as if just the tide might be shifting underneath these firms.
Yeah, I mean, they would say basically that's the hedge for them. Blue Owl co-CEO Doug Ostrover basically said he's super bullish on digital infrastructure, expressing some very certain sentiments about kind of their decisions and their exposure on that front. So they basically believe that, you've got software on one hand and then you've got digital infrastructure and their exposure to AI on the other. And in theory, if AI were to disintermediate software, they should balance each other out. Now, the unknown that's out there, and I think this is why you're seeing these stocks get whipsawed so much over the last week, is yes, you've got kind of direct exposure with private equity, you've got direct exposure with private credit, which most of these executives have said is pretty minimal, just less than 10% across the board for each of those various products. But then you also have areas like GP stakes, which may mean indirect exposure. You've got other types of financing, which may mean indirect exposure, and then you may have exposure to places, that may not be software in the kind of the software category, but still are at risk of being disintermediated by AI. So that's what the market is concerned about right now.
Yeah, all wrapped up in kind of an opaque bundle there.
Yes,
Leslie,
they're concerned about what they don't know.
Right, no, exactly. Shoot first. Really appreciate it. Thank you, Leslie Picker.